Central Garden & Pet distributes pet, lawn, and garden supplies, although most of its business is pet-related. The stock got obliterated when the company reported a hideous quarter in February. CEO George Roth tried to reassure his investors, but then 5 days later, he announced his upcoming planned retirement. It didn't help that Central Garden & Pet gets 40% of its sales from the garden side of the business, and gardening got a very late start this year because of the awful weather. Tell me about it as a gardener. The good news is Central Garden has already bottomed after the company delivered better than expected results in May. At these levels, the stock has gotten a lot cheaper than it was last year, and you know what? It would be a mistake to totally bail on it. So let's keep Central Garden & Pet in the ETF, but cut its weighting from 10% to 5%. Next up, there's Pet IQ. It's a maker of drugs for animals, as well as an operator of veterinary clinics. We just had a very bullish conversation with the CEO right before we created the Humanization Pets Index. However, his stock had also run from the mid-20s to just under 40 in a very short period of time. And in retrospect, I was chasing when I recommended it at that level. That was wrong. Sure enough, Pet IQ was crushed during the growth sell-off in the fourth quarter, and it's never really come back. Plus, it doesn't help that the company reported a not-so-hot quarter in March, and then some short sellers started going after them for their VIP pet care acquisition, which gave them the veterinary clinic business. We like that business. However, last month, Pet IQ reported a solid quarter. And we learned that they're acquiring Parago's animal health unit for $185 million in a deal expected to be additive to earnings within a year of its closing. While I don't have a great read on that VIP pet care situation, the story seems intact to me, and I still think that has enormous potential. But we want to cut Pet IQ's allocation from 10% to 5%. Leave it in the portfolio. Now, third, there's Pet Med Express, the company behind 1-800-PET-MEDS, America's largest animal-oriented pharmacy. This stock had already been pulverized when we created the ETF. They recently reported a shortfall, and I should have followed my own rules by keeping it in the penalty box. Remember what I always say? A shortfall means you got to at least wait 1 quarter. I didn't listen to myself. PetMed's struggling with new competitors in the space, including Chewy, and an online pet pharmacy launched by Walmart. While the stock seems cheap, I have a hard time believing PetMed will be able to make the numbers. So we're removing it from the Humanization Pets ETF entirely. Sorry, go on. We also need to remove Henry Schein. Why? Because the company spun off its animal health unit back in February. They merged it with Vet's First Choice to create a new entry, Covetrus. Covetrus. Wasn't that like that could have been that bank, that BB&T and SunTrust? Covetrus. Or it could have been the plant division of DuPont Dow, or you know what I mean? Now, this company is a major distributor of veterinary supplies, but its stock has been a dud so far, in part because Covetrus laid an egg in its first earnings report as an independent company. Plus, it's not cheap, selling for 25 times next year's earnings estimates. The company is an important player in the pet space, but it still needs to prove itself. So let's put it in the ETF, but only with a 6.25% weighting. Speaking of breakups, late last year, Eli Lilly spun off its animal health division as Elanco. Unfortunately, the stock's basically been dead money since the first trade. It surged from 24 to 32 right out of the gate, and that's where it stayed. Problem? Lilly spun out of Elanco via an IPO, which led investors to bid up the stock, and it's been digesting those gains ever since. Still, I like the company. Straightforward story. You know what we're going to do? We're going to give a 7.5% weighting. Finally, there's Chewy. Yes, Chewy. I like Chewy. The online pet store that we joined this weekend, that's right. It's upending the whole industry, which exploded higher when it came public on Friday. Like I told you at the time, I adore Chewy, the company. But ideally, yes, I would like to wait for the stock to cool off a bit before I endorsed it. That said, it's a lot less expensive than it might seem. I say we give it a 12.5% allocation, although, again, if you want to buy it, you should gradually buy it on the way down. But I do sanction buying it a little bit right here. Bottom line, the Humanization of Pets has been a fabulous secular growth story, one that's really paid off in 2019. And now that we've adjusted our Mad Money Pets ETF, I bet it can keep going higher.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.